In the world of stock market, we often hear about trading and investing. These are like two different roads to make our money grow and secure our financial future. Trading and investing share a common goal to enhance our financial standing, but they work in very different ways. Now, the big question is which approach is best? How do you decide which path to follow for success? We promise you that this video will help you clear the dilemma between stock trading and investing and will provide you with the insights to choose the best financial path for yourself. Welcome to holisticinvestment.in. Navigating the initial question, trader or investor. When you start your investing journey, the first and foremost question that comes to your mind is whether you should be a trader or an investor. During bear markets, a trader may become long-term investor. In such a situation, the traders may think of holding a stock for a longer period than they intend to. The reverse also happens. In both of the situations mentioned earlier, the investors' action are guided by the movements of the market. When this happens, the true aim of building wealth can become uncertain. It becomes challenging to be fully a trader or a long-term investor. Therefore, it is advisable to resolve this dilemma. It is best to choose one path, either to be committed investor or a trader. Trying to do both simultaneously might not yield the desired result. However, if circumstances require it, you could consider having a separate portfolios, one for trading and one for investing. This approach helps provide clarity on what actions to take. By doing so, you will have a clear direction for your financial decisions. Let us analyze how people end up in losses by analyzing the cumulative effect or the sum games of the trading and investing style. Investing positive sum game. The concept of investing is a catalyst for generating wealth. It involves a deliberate choice to allocate your funds to a particular financial instrument like stock, mutual funds, bonds, or real estate. It means that you are essentially becoming a part owner of a company or an asset. Once invested, you patiently allow your chosen asset to appreciate over time. As a company or asset grows and succeeds over time, the value of your investment increases. For instance, if you own 1,000 shares of ITC and if the company's sales and the reputation increase, your investment becomes more valuable, resulting in a positive return. Trading can sometimes resemble a negative sum game. In trading, individuals often aim to profit from short-term price fluctuation in assets like stocks or currencies. For example, if you sell a stock at a higher price than you bought it, you make a profit. But someone else who bought at a higher price and sold it at lower price incurs a loss. In this scenario, for one trader to win, another trader has to lose. Net, there is a win-loss in the scenario. It is like zero-sum competition where gains for one party comes at the expense of losses for another. This dynamic can lead to a situation where overall wealth doesn't necessarily increase. It is just redistributed among traders. This does not imply that traders are consistently at a disadvantage. So, the lower the likelihood of losing your money, the higher the probability of achieving good returns. Now let us explore wealth creation under investing and trading. Investing relies on fundamental analysis and generally involves lower risk. Two things matters here. Selecting the right stock or mutual funds. Next, holding on your investment for at least a decade to see the real compounding. This approach helps you ignore the stock market noise and stick to the disciplined strategy. Since you have chosen a stock based on the strong fundamentals, they offer protection against significant drops in the value, safeguarding your invested money. In mutual funds, you need not worry about stock selection as the fund manager do that for you. Over the longer run, the mutual funds start to bear fruit. According to research done by CRISIL, shows no single SIP gives a 0% return when it is invested over a longer time, 10 plus years. So you are not going to lose anything when you invest over 10 years. This is where the real compounding effects takes place. Now we shall shift focus on long-term wealth creation in trading. The idea of quickly making a lot money is attractive to many people who get into trading. While it is true that you can make fast profits through trading, it is not easy to consistently create wealth this way. A single bad trade can result in the substantial losses that are not easily recoverable. Moreover, the rapid pace of trading can expose us to sudden market shifts, external factors, emotional decision making, all of which may lead to wealth destruction. Even though you might win some trades by doing many transactions, these wins are often offset by losses. This creates a situation where it is hard to achieve lasting financial growth. In the end, there is not much wealth created here, unlike investing. Hence, investing scores over trading when it comes to long term wealth creation. Now, we shall look at how to deal with the unknowns under trading and investing. In both investing and trading, there are things we can't control, like interest rates and big economics changes, such as how well the economy is doing or the results of elections, etc. These things affect how much stocks are worth, but they are hard to guess or handle. This is true for both investing and trading, but trading is more unpredictable because it happens quickly. One good example from recent time is that COVID-19 breakdown, which caused erratic movements in the market. This may cause an emotional imbalance in the investor's mind, and he or she may also not decide to participate further in it. If you are investing for the long term, these uncontrollable things don't hurt as much. There might be some temporary effects, but they usually don't mess up your investments in the long run. But in trading, these outside factors that we can't control can make trading hard and cause losses. Next, tax implications. Investing versus trading. When you invest for the long term, the taxes you pay are usually lower. You buy now and sell after many years, so you will be paying the long term capital gains once you sell the stocks. When it comes to trading, the cost can be higher. If you are trading often, like every day or every week, the expenses add up. If you are a trader, the tax rules are different, and you might end up paying more tax because your profits are counted as business income. You will have to show them as a part of your ITR and have to pay the short term capital gains. So, from tax perspective, long term investing is usually better when compared to short term trading. Next, great fool theory. In the world of trading, there is a concept known as greater fool. Let's dwell into a recent incident that vividly illustrates this principle. IPOs of highly anticipated companies like Nykaa, LIC, and Paytm generated substantial excitement across social media platforms. However, once these stocks began trading on stock exchange, they took a downward turn and experienced significant corrections. The trader's mindset would be looking to sell after listing. They anticipate that someone else would buy these shares. Isn't this a prime example of the greater fool theory in action? But you can change the entire scenario by being a prudent investor. As an investor, you would plan to hold these stocks for a longer time period, say 10 years or so. In that case, you would have studied the fundamentals in depth and various ratios, and you may not have opted for such high valued companies. Before dwelling into discussion about market dynamics, let's pause and ask ourselves a fundamental question. How many of us can truly predict unpredictable events in the stock market, such as the COVID crash, the 2008 bubble burst, or the recent Russia-Ukraine war crisis? We might have some insights, but can we accurately forecast the exact percentage by which Nifty or Nasdaq will decline? The reality is no one can. If there were such a person, they would be the ultimate trading expert, capable of pinpointing turning points and shift in trends with precision. Since none of us foresee these events, trading carries a higher risk, potentially leading to capital erosion. As prudent investors, we shouldn't be swayed by such illusion. Instead, let's stay the course with our SIPs to steadily build our wealth. What should you do? Now that we all realize how investing can reduce our probability of capital erosion, what should be our next step here? We should invest in quality stocks and choose the right mutual funds for the long run. There are many criteria, such as how to select the good fundamentally strong stocks and funds for the long run using different scanners. Investing in the long term is not only about making money gradually, but also about making your investment less risky. One way to do this is by SIP. SIPs allow you to take advantage of time when the market is down and stocks are cheaper. You can get stocks at much lower prices and can accumulate more units in your mutual funds at a lower NAV. Here is our final conclusion. Stay invested in your investment no matter what the market is doing. This means keeping your investments even when the market is going down, that is corrections, or when it is going up a lot, like bull market. This way, you are ready to get good results from both the times when the market is doing well and when it is not. This helps you have a strong and flexible investment plan. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.